Hey, great to be here. Good to see everybody again. Yeah, seasonal weakness is typically what happens around this time of year. I'm going to show you a lot of reasons why. However, I'm going to show you why there's not a lot of reason to be scared just yet. I mean, you'll see how I expect it to play out, and I think it'll make sense as well. So let me dive into here. So yeah, we're going to look at presidential cycles. We're going to revisit that. The same charts have been showing every year, and just give us some good context for where we are now in the cycles, in the presidential cycle, where we are, where we could be going, where we typically go is what I'm wondering. We're going to look at the current money flow stats, which I love. Money flow drives the market. Where money goes, that's where the market moves. So you want to watch for those. And then, there's now a 96.5% chance the Fed will lower interest rates on September 17th. And I think that's an interesting date, and we're going to look at that as well. So keep that in mind, September 17th. Right, so typically, this is the last 25 election years. Typically, August is bad, then September is bad. Now, interestingly, August was actually fine. It was pretty flat. It was up a little bit. It wasn't an amazing month, but it wasn't bad. Nothing to be concerned about. So, but typically when August is good, September, right, we have a good August, September gets the whole hit instead of just part of it. So that's what I'm considering being the outcome for this year. And in addition, I threw on here the average return by month for each month. September, the average return is not good. It's typically close to negative 1%. Now, that's not a huge number, but that's an average of, I believe, back to 1950 was this chart, where this is only 10 years in the background here. But typically, the average return for a lot of years, 75 years, has been negative on the September indexes. So you keep that in mind where we are. And like I said, typically when August holds up okay, the hit comes in September in a bigger way than it would otherwise. So you kind of have to weigh that and see, is that relevant now or not? But if we start seeing the money flow set up and say, hey, there's something wrong, then that's what I would expect to see. But until then, we kind of watch the money flow and say, we're okay, but be on the lookout for this kind of problem to show up in the near future. Right here, more seasonality. This is Optima's version of it. And here they have it day by day. So actually, the first part of the month is not bad. And that's kind of where we are now. I think we're on the 4th here, positive day. It's been kind of messy and choppy, but generally the sense is positive. We get a little lull around the 10th to the 12th, another good day. And then the 17th, remember that key day? Positive. And then we might get a positive follow through a little bit from that. That is what I would expect to be a fake out going into the second half around the 20th, 21st. Interestingly, is also the equinox. So that's just a lot of interesting things going on at that time of the month. So the Fed's going to cut. That's going to feel great for maybe 2, 3, 4 days. And then I want to really, really watch out for problems coming in right around the 21st, 22nd. That's kind of what typically happens. And I'm really curious to see how this plays out this year. That's what we're watching for. Here are the money flow factors that I care about. So we're looking at the long-term chart of the NYSE advanced declines. This are more stocks going up than down on the NYSE. The NYSE has a lot of stocks on it, so it's a really good broad understanding of what's going on. So if we start breaking down here, this is the 21 like we did here, but if we really break below this blue line, then we've got a problem. We're going to have quite an ugly time if we break down below there. Historically, I built this in 2015, really just to make sure I stayed out of leverage when things were in really bad situations. So it's really has been a good thing to pay attention on. Back here in March and April, it stayed below, so there's really no reason to be too aggressive. But then once we got the end of April, it's been pretty comfortably, steadily good. It means money's coming into the market, money's not flowing out. So that's, again, money drives price ultimately. Our midterm cycle actually went negative yesterday. This is really interesting. We had more money flow on the shorter term, pushing down to the negative. We are actually still negative today as of right now, even though the market is up a little bit. Not a huge day, but not a bad day. Short-term flows are a little bit muted. If it starts pushing below this 200 line, then I'm much more concerned than I am right now, because money flow's okay. This isn't bad. It's just not great, not inspiring. Another factor we're going to look at to say what drives where we need to be. And the current market index is the only one on the negative right now is the NASDAQ, which is interesting because that should be leading the market, whether up or down. I want to see that leading over here. And it hasn't been. It's really been the weak index, although I think it's slightly more positive than the S&P today, but earlier wasn't. So we'll have to see where that goes. But the strongest has actually been ILF, which is Latin America, China, and small cap and mid cap. I mean, that's places that are really highly volatile that I don't really like to mess around with too much because they go wrong so quickly. So I really don't necessarily like to be invested in these spots, but it's good to note where the leadership is. And then we have Dow, S&P, emerging markets, Japan. So not a strong trend, but they're positive. And then these guys are weakening down here in the bottom half. S&P weakening, emerging markets, Japan, developed nations, all weakening over here. So they're likely heading over to this side as negative, unless we get the Qs participating on the left side, then it'll be a better spot. But for now, it's just very mixed and nothing inspiring about this market. And this time of year, this is when the surprises happen. So don't be eager to get too aggressive right here. I mean, if anything, we're thinking about how to be less aggressive as soon as we need to be. Diving into the sectors, again, we have technology, big surprise. On the weak side, same with real estate. XLP is consumer staples and utilities. It's a very mixed. Usually these bottom three are the defensive, so they're not helping. Over here, the positives, we have energy and financials. Okay, financials should lead. XLC is communication, which is really just technology. That should be strong, but it's really just not inspiring. There's not a lot of strength. It's just kind of chopping around. Not too much to grab onto. I want to see more moving in one way or the other before I'm inspired to do something in the direction. But right now, we're really watching more of the positives turn negative, and if that cascades, then we'll see the other factors start to turn negative as well. The RRG, this is not inspiring at all. Big names down here in the red. We've got the only thing really pushing up here is real estate. It's not a sector I love that much. Energy is up here, about to roll over. Everything else is just looking messy and ugly. Everything pushing down into here. Again, as I've said many times, what I'd love to see is when all of these get grouped somewhere in this red box, the next time they push up, that's when a really nice rally is about to hit. But this isn't, when we're up here in the green box and pushing down, that's when the market's getting tired. A little bit is slowing down, and you don't really want to be too aggressive here. So real estate is not a big sector of the S&P. So seeing that there really doesn't do much to influence it in either direction. And then finally, new lows. This is something I've been watching more and more recently. I think we put this in the newsletter this past month. See it on our website. What we're looking at are the new lows on the NYSE getting below 50 or below 100 or even more, or breaking down. When you really see these breakdowns, you know there's something wrong in the market. But then this also gives you hints as to when it's over a little bit sooner than other things I've been watching. So I'm really paying attention to this. But yeah, for now, we're cruising up here above 50. So fewer than 50 stocks in the NYSE are hitting new lows. It's not really a lot to be afraid of, but this starts breaking down, then we'll be paying attention very intently on what we need to reduce and play defensive. So that's the play. That's the game plan. I laid it out for you right there, and I hope that helps you going forward.